Ready to peek behind the curtain of Wall Street. Today, we're cracking open John Train's The Money Masters to see what makes some of the most successful investors tick.
This book doesn't just throw random investing tricks at you. It gets into the minds of 9 wildly different investors, from Warren Buffett to, get this, a commodity trader named Stanley Kroll.
Okay, so we're talking about a pretty diverse group here. What's the common thread? What makes them money masters?
That's what's crazy. There's a common thread. Train boils it down to 2 main ideas: cautious futurology and laboratory analysis.
Cautious futurology. Sounds kind of mystical. Are we talking crystal balls and market predictions here?
Not quite crystal balls, but definitely seeing the future better than the average investor. Think of someone like Jeff Bezos. He wasn't the first to sell stuff online.
Right, but he saw the potential of e-commerce way before most people.
Exactly. That's cautious futurology at work. These investors don't just focus on today's numbers. They're looking at the long game, a company's trajectory, its advantages, its potential for growth. Like Bezos betting big on the internet before it was the norm.
So they're not chasing fads. They're looking for something with staying power. Kind of like, I don't know, investing in Coca-Cola back when it was just a soda fountain drink.
You got it.
Yeah.
It's about understanding a business so well you can make smart guesses about its future, even if that future isn't clear to everyone else yet.
Okay, that's cautious futurology. What about laboratory analysis? Does that involve, like, spreadsheets instead of test tubes?
More like dissecting a company under a microscope. These investors are masters at gathering every bit of data and really picking it apart. Financials, the management, the competition, you name it.
So looking for strengths, weaknesses, that kind of thing.
Exactly. And what's cool about this deep dive is that we'll see how these principles actually played out in the careers of each investor.
Yeah, I think what's exciting for me is we'll see how they use these ideas to actually make money, and hopefully how we can avoid some common traps along the way.
That's the key. Each of these masters had a method, a system, and they stuck to it, even when things got rough.
Like, you don't change your golf swing in the middle of your backswing, right?
Exactly. They tuned out the noise and trusted their analysis. And that's what we'll explore today, because building wealth isn't about luck. It's about discipline, patience, and truly understanding the businesses you're investing in.
All right, let's meet these masters. First up, the Oracle of Omaha himself, Warren Buffett.
The guy was practically born an investor. I mean, even as a kid, he was obsessed with business, calculating odds at the racetrack, even selling his own tip sheets.
Sounds like a natural. But did he always follow this value investing approach?
Actually, he started out with technical analysis, trying to predict the market with charts and patterns.
Charts. Interesting. So what changed?
Benjamin Graham happened. Reading The Intelligent Investor was a turning point for him. Instead of trying to time the market, he learned to look for those undervalued companies, the hidden gems everyone else was missing.
Buying a dollar for 50 cents, right? That's classic Graham.
Exactly. Buffett started searching for solid businesses with strong fundamentals. He wasn't looking for the next trendy thing. He was looking for companies with a real competitive edge.
And ones with good management too, right? I remember reading about how much emphasis he puts on the people running the business.
Oh, absolutely. He wants what he calls owner-operators, people who treat the business like their own money is on the line. He wants to see people who know how to reinvest profits to grow the company for the long haul.
Which explains why so many of his investments are in these iconic, long-standing companies.
Exactly. Coca-Cola, Gillette, American Express companies with strong brands, products people love, and a proven track record of making money. And that's key, because no matter how smart a manager is, they can't save a fundamentally flawed business. Buffett said that himself.
He does have a knack for quotable wisdom. Speaking of wisdom, let's move on to another legend, Philip Fisher. What made his approach unique?
Fisher was all about growth, but his research was really different. He used something he called the scuttlebutt method. Basically, he talked to everyone and anyone who could give him insights about a company. Competitors, customers, even former employees, you name it.
Wow, so he really did his homework. He was like a detective piecing together a puzzle.
Exactly. He wanted to get the full picture, not just rely on financial statements. Because, as he said, the scuttlebutt method can be way more valuable than anything you'll read in a textbook. And, this unconventional thinking, this going above and beyond, it really shines through in that story about him bulldozing his house.
Oh, you've got to tell that story. For our listeners who haven't read the book, what happened?
So Fisher had this problem with his house. The way the windows were positioned made it unbearably hot in the summer. Most people would just, suffer through it or install some AC. Not Fisher. He bulldozed the entire house and started from scratch.
That's commitment.
Right. But it just shows you this wasn't some eccentric millionaire. It was a man who believed in finding the best solution no matter how unconventional it might seem.
Always thinking outside the box.
And when it came to investing, that meant finding companies with exceptional management and a real competitive advantage. Those were his big things.
Which seems to be a recurring theme, right?
Absolutely.
Yeah.
Because at the end of the day, a company is only as good as the people running it and its ability to outperform the competition. Now, we can't talk investing legends without mentioning the father of value investing, Benjamin Graham.
The author of Security Analysis, the Value Investing Bible.
That's the one. Graham was all about meticulous analysis. He believed in finding the intrinsic value of a company and then buying it for less.
Buying with a margin of safety, right? To cushion against market swings.
Exactly. And this wasn't just some theory to him. He lived through the Great Depression, saw firsthand how devastating speculation could be.
So he knew that markets could be irrational, even dangerous.
You got it. And those experiences really shaped his investment philosophy, made him incredibly risk-averse. He wanted to protect investors from those wild market swings. But here's the really cool thing about Graham later in his career. He simplified his approach even further.
Really? So even people without finance degrees could follow it?
That was his goal. He started focusing on companies with strong balance sheets, especially on what he called net current assets. Basically, assets you can quickly turn into cash, minus any short-term debts.
So a pretty straightforward concept to grasp.
Exactly. He found that this simple metric could actually lead to some impressive returns. Now, if you want to see Graham's ideas in action, look no further than Tweedy, Brown & Co. These guys have been using his principles, pretty much to the letter, for over 50 years.
That's impressive. Talk about sticking to your guns.
And it's worked out pretty well for them. They've consistently beaten the market just by staying disciplined and sticking to Graham's core principles.
The book describes their strategy as fishing with 1,000 hooks. What does that even mean?
It basically means they're incredibly patient, they're casting a wide net, looking for those undervalued opportunities. But they're not in a hurry. They know that eventually the right opportunities will come along.
So patience really is a virtue, especially in investing. Okay, enough with the value investors. Let's talk about someone completely different. Stanley Kroll, the commodity trader. Now that's a different breed altogether.
Talk about high stakes. Kroll was known for his discipline, his uncanny ability to spot those big market trends before anyone else.
Commodities are a whole different ballgame though, right? Much riskier than picking stocks.
Absolutely. It's all about understanding global supply and demand, things that can change rapidly and unexpectedly. You need nerves of steel to succeed in that arena.
Speaking of nerves of steel, I read this fascinating anecdote about Kroll taking a vacation to Switzerland. Apparently, he was in the middle of this huge wheat trade that was consuming him.
Oh yeah, the pressure was intense, even for someone like Kroll. So what did he do? He completely disconnected, went to Switzerland, surrounded himself at the Alps, and just completely cleared his head.
Now that's discipline, to just walk away from the market like that when millions are on the line.
It takes incredible mental strength, something not everyone has. And that's something the book cautions against, trying to emulate Kroll without his experience and temperament. Commodities are just too volatile, too risky.
It's not for the faint of heart, that's for sure.
Yeah.
All right, let's shift gears again, this time, to T. Rowe Price, the pioneer of growth investing. Now that seems like the opposite end of the spectrum from Kroll's world.
It's definitely a different philosophy. Price was obsessed with finding those companies in their early stages of rapid growth. He called them dynamic growth stocks.
So we're talking about the next Apple, the next Amazon, right? The companies that are changing the world.
Exactly. But he wasn't just chasing hype. He had specific criteria he looked for, like strong management teams, innovative products or services, and a huge potential market. He was very calculated in his approach.
So a healthy dose of pragmatism mixed with that search for the next big thing.
Exactly. And he knew that timing was everything. He understood when to get in and when to get out, even if it meant leaving money on the table. Like when he sold his stake in his own firm, T. Rowe Price, right at the peak of the growth stock boom in the late 60s.
Wow. Talk about discipline. He understood that even the most promising growth stories don't last forever.
Exactly. He knew that markets go through cycles and that even the most innovative companies can become overvalued. Okay, ready for another contrarian? Let's talk about John Templeton, a true pioneer of global investing.
Templeton, the guy who made a fortune betting on Japan's post-war recovery. I'm ready for this one.
Templeton was a master at finding those overlooked opportunities. He'd look for value where others saw only risk, often in markets that other investors wouldn't touch. He wasn't afraid to go against the grain, and it paid off big time.
The book talks about his fascination with companies that were doing something new and different. He'd probably thrive in today's market with technology moving so fast.
Absolutely. He understood that true innovation creates incredible opportunities, even if it means going against the crowd, betting on the underdog.
Which takes guts, especially when everyone else is running for the exits.
It certainly does. Okay, let's switch gears one last time and talk about Larry Tisch, who Train describes as a real pragmatic investor.
Pragmatic investor. I like the sound of that already. What's his story?
Tisch had this knack for finding value where others didn't, often in distressed assets or companies that others had written off. He also understood that markets are driven by emotions.
Emotions, you mean fear and greed, that kind of thing?
Exactly. And he used that to his advantage. He once said, "I have no system. I'm a pragmatist. I just wait until the fourth year when the business cycle bottoms and buy."
So he waited for that moment of maximum pessimism when everyone else was selling to swoop in and buy low.
That was his strategy. He combined that understanding of market cycles with a keen eye for identifying solid businesses, like his fascination with Coca-Cola. He saw the long-term value of that company even when it was out of favor.
Okay, last but not least, we've got Robert Wilson, the short seller. He's kind of the black sheep of the group, isn't he?
He's definitely unique. While everyone else was looking for companies to buy, Wilson was looking for companies to bet against.
That sounds incredibly risky. How did he make it work?
It took incredible research, a deep understanding of the companies he was targeting, and a lot of guts. He was basically saying, this company is overvalued and I'm willing to bet on it going down.
Talk about going against the grain.
Right. But even the best short sellers get it wrong sometimes. The book tells this cautionary tale about Wilson's bet against Resorts International, a casino company. He was convinced the stock was going to tank, but it ended up skyrocketing, costing him a fortune.
Ouch, that's gotta hurt.
It just goes to show you that even the smartest investors make mistakes, and that risk management is essential, especially when you're swimming against the tide.
So we've met the money masters. 9 different investors, 9 different approaches, but all incredibly successful. What's the key takeaway here?
That there's no magic formula, right? What matters is finding an approach that clicks for you, that fits your personality and your goals.
Your investing style, kind of like finding your voice as an artist.
Exactly.
Yeah.
But after looking at all these different styles, let's go back to those core principles we talked about: cautious futurology and laboratory analysis. What can we actually learn from them? How do we put those into practice?
Yeah, give us the actionable stuff. How do we take these big ideas and turn them into, well, bigger portfolios?
Well, the first thing that jumped out at me reading about all these investors was how much they stressed really understanding the businesses they were putting their money into.
It's like Buffett always says, invest in what you know.
Exactly. Don't just chase the hype. Figure out what a company actually does, why you believe in it. That leads right into the second big takeaway. Ignore the noise.
All those market swings, all the pundits making predictions, it's easy to get swept up in it all.
And these masters were masters of tuning it out. They focused on the long game, not the quick buck. And that takes us to takeaway number 3, patience.
They weren't trying to time the market, they were playing the long game.
Exactly. Let those investments compound over time. Rome wasn't built in a day, and neither is a killer portfolio.
And that leads us to a point that's especially relevant after hearing about all these different approaches. Know yourself.
Right, know your risk tolerance. If you can't stomach the ups and downs of growth stocks, maybe Graham's value approach is a better fit. The point is, find what works for you and stick to it.
So much good stuff in this deep dive. But where do we go from here? How do our listeners take these principles and turn them into action?
That's the exciting part. This book doesn't just tell you what these guys thought, it actually gives you the tools they used.
We're talking specific criteria, numbers they looked at, that kind of thing.
Exactly. Things like net current assets, return on equity, understanding what a durable competitive advantage really means. These aren't just buzzwords. They're the building blocks these masters used.
So step 1 is understanding the tools, then we can start building, right?
Exactly. The Money Masters is a great blueprint, but you have to pick up the tools and start building your own investment strategy.
And remember, you don't have to go it alone. There are tons of resources out there, books, podcasts, you name it.
And the best resource of all, experience. Start investing, even if it's just a little bit. You'll learn as you go, make mistakes, get better. That's part of the journey.
Love that. It's about constantly learning, growing, becoming a better investor every day.
That's what makes it so interesting. There's always something new to learn, a new challenge, a new opportunity.
Well said. So as we wrap up this deep dive, what's the one thing you hope our listeners take away from all of this?
That investing isn't some big mystery, some exclusive club. It's for anyone who's willing to learn and put in the work. By understanding the principles that drove these money masters, you can gain the knowledge and the confidence to make smart decisions and build that financial future you've always wanted.
I love that message. And remember, we want to hear from you. What were your big takeaways from this deep dive? Head over to our social media pages and share your thoughts, your questions, anything that got you thinking. Until next time, happy investing.